Anyways, my name is Naeem Zafar, and I am a TiE charter member for the last 16 years. And I think I gave you my bio before, so only for the 12 people who didn't hear it. I've been starting companies since I was 26. One of my companies was a fingerprint sensor, which is now in iPhone 5 and iPhone 6. We were doing it 15 years too early, so we ended up selling the technology, which Apple bought. And if you my last company was in mobile security, which Oracle acquired. And my current company is in IoT space. So any of you hardware designers and embedded people, and love to talk to you, because we are building the team, have a product, and we're getting out there. So I have a lot of experience starting companies, raising money, selling companies, dealing with all the problems which happen. And we're going to be doing a talk 2 weeks from tonight, which is about making the transition from a founder to a CEO. Because nobody teaches you that in any school. And I had to learn it the hard way. And it was pretty hard. So I'm trying to summarize all the things I have learned, how to make that transition from being a good engineer, perhaps a founder, to a CEO, because it's totally different challenges. So we'll talk more about that in 2 weeks from tonight. This was the one which was supposed to be 3 weeks earlier, but had to be rescheduled because of the blizzard. So again, if you forget some of the things I said, or you want a more comprehensive look at it, these books I took 3 years to write the 5 books. So these can guide you anywhere from how to get started, how to deal with legal setup, to how to do market research, to how to get funded. So you may want to think about getting them. You can download the PDF from this website, 5 Mountain Press. They're also on Kindle and Amazon. So today's topic is about term sheets, dilution, how does funding works, what happens to share, all those things. So we're going to just review a couple of slides so some of you who were not there can get caught up. So this slide kind of summarizes what a company goes through when it starts as it grows. So this is the whole life cycle. When you start in the beginning, you have nothing to show. The only source of seed capital are angel investors or friends, families, and fools, FFF. But once we have some kind of a thing showing something is moving, basically a box that beeps or something equivalent, then you are ready to talk to venture capitalists. And there are early stage VCs and late stage VCs. When you go to them, they're the one who will put a price on your company, and you'll negotiate how much money you need in exchange for how much equity. And the first time they issue a preferred share, it'll be called Series A. Every time you issue a new set of shares to new investors, because the price is changing, hopefully, and some other conditions may be changing, you can't call them the same shares, so you bump up the number. You call them Series A, Series B, Series C. And if all goes well, at some point you get to a later stage, you may do a mezzanine round, and then you have an initial public offering when you are stable enough that you're allowed to sell your shares to a common man on a stock exchange. So this process can take from here to there anywhere from typically 5, 6, 7, 8 years. Many companies don't make it all the way here because they get picked up, acquired somewhere down here. So this is just to set some terminology straight. And by the way, like I said last time, if you have comments, questions, or disagreements, feel free to pop your hand and we can deal with any of those questions. I'm used to dealing with rambunctious students at Berkeley and at Brown, so that would not be a problem. So don't wait till you question. You think my question is too dumb? Trust me, it's not too dumb. There are at least 2 dozen people who have the same question and they're too afraid to ask. Well, here's a demonstration.
Can we get copies of these slides later on?
If you insist and 10 people request, yes.
Okay, I insist.
Yeah. So I think the Vanessa posts them. Basically, we integrate them with the video, and they go up. And I will tweet about it when next one becomes available. So you'll be able to do that. And yes, slides will be available.
Thank you.
So we talked a little bit last time about how do you raise money from your friends, family, or angels, which is a little bit different than VCs typically, because these friends and family don't know how to value your business, especially a business which has no cash flow. If you have a business with a cash flow, like a grocery store or some other place, you can, 2 times sales, 3 times sales, you can come up with some reason. But early stage company has usually no revenue, so how do you value it? So this is job for professionals and VCs. So a common person, the easy way to do that is you do a convertible debt, a loan. And convertible note is a simple 1 or 2 page document which says I'm loaning you $50,000 in exchange for the intellectual property of the company. And when somebody actually puts a value on it, then my loan will convert into equity. So this is the simple concept behind a convertible note. That's how the easiest way to raise money from friends, family, and angels. So you don't have to have difficult conversation, what is the company worth? Okay. So far so good. Any questions on this? As you can, so I'm repeating a little bit because I did this last time, but just to, it won't dwell on this too long. Yes, please go ahead in the back.
Will you talk about the cap versus discount?
Yes. That's you're stealing my future slide. Yes, very much coming. So there are 2 problems with this convertible note. We're going to deal with them one by one. Yes, sir.
How do you value the IP of the company when you're using it as a collateral?
You don't. Whatever the note is for, that's the value of the IP. So because you're hoping that will never be a question. You're hoping that you will raise money, and then this is a non-issue. The other scenario is that you don't raise money, you're out of business, then who cares? So either way, it's not an issue which never ever comes up. Yeah. So this note it looks attractive, it's simple, it's quick, but it has 2 problems. One problem is, wait a minute, I'm giving you money in January, you're going to raise money from maybe VCs in November. Hello, I'm taking a lot more risk. Why do I get the same price as them? Why, if you convert my loan into debt, that's not fair. So the answer to that question is, we'll give you a discount. Don't worry about it. We'll give you a discount. If the price for VCs will be 68 cents a share after much negotiation, you're going to pay 52 cents a share. So you'll get more shares. Okay, that's how you solve it. So that's the simple answer. So you'll get a better price, and typical answer is 20% discount from the whatever VC is going to pay. But you can negotiate this too, because somebody who paid the money 6 to 9 months in advance, he may get 20%. Some other money came in just like 1 month before. So okay, that may be a 10%. So you have some, but typically it's 20. You could negotiate. Somebody says, hey, it's taking more than a year for raise money, then I need bigger than 20, maybe 25. So point is, you negotiate some discount, and that's how you deal with this additional risk you're taking. What's the second problem? Second problem is, okay, so I'm giving you $50,000. I'm hoping I'll get maybe 2, 3, 4% of the company, because I'm hoping your valuation will be $2, 3, $4 million. What if you're too successful? Because you do such a good job, now company is worth $30 million in the Series A. So for my initial seed money, I get almost nothing. I get 0.5%, but I took all the risk. So how do you solve that problem? Well, you put a cap on the valuation that even if the company is very successful and VCs are paying 20 million or 30 million for their shares, you will pay no more than a number, maybe 5 million. So this is how you can protect people who take this early risk, that they have a cap on their valuation. They will not pay more than some pre-agreed amount. A typical number is like 3 to 5 million. So anybody confused about this? Because that's all we're going to say about this.
So you don't get a discount on the cap on valuation.
Yeah, you got a discount on the price. So suppose the price was, so you don't double dip. That's the short answer. So either you hit the ceiling and you pay that price, or if it's below ceiling, then you get 20% less than, yeah.
Quick math. So if someone used 1 million cap as 5, and if the company is valued 100, do they get like 20% because the cap is there? How does the math?
No, this is the question he was asking. So question being answered is, suppose you had a cap of 1 million.
Cap is 5.
Cap is 5 million.
Initial investment
is in 1 million.
And then the eventual Series A valuation is 100 million.
So 100 million. So the price you will pay would be as if the valuation was 5. Because you hit the cap, that's the price your share will convert at. So obviously, investor want as low a cap. As an entrepreneur, you want as high a cap. And so, some reasonable number is something like this, 3 to 5. Could be 2, could be 7, could be 10, but in that range. So this is two ways to simplify this whole thing, which can go wrong. So that's all you need to learn really about these convertible notes. And if you go to search on the internet, there are many examples of convertible note. Of course, you may want to talk to an attorney, make sure it doesn't have any gotchas. Now the question is, how much do I give to various people I'm going to hire? Yeah.
One question, from a founder's perspective, does it matter? Is one way better than another, discount versus cap?
Well, so question was, from the founder's perspective, do you want low cap or high cap? And answer is, you want a little bit high cap, because if the cap was too low, then you end up issuing more shares to those people. But chances are, most of the time, initially who give you convertible notes are friends and family, or maybe angel investors. So you're not like complaining too badly, because there's the people you know. Because only people you know will give you money at that stage. So if they get a little bit more money, a little bit more shares because cap was not a super high, that's a good thing. Don't worry about it.
So 20% discount with no cap probably is better for founders than for
Probably, and most people were doing like 20% discount and no cap. Cap was really invented more recently. And that only happened because Dropbox was too much of a success. Everybody freaked out. And a question in the back over there? Yeah.
Do I need to take are we going to get a copy of this slide?
Yes. we shall do that. Yes, please.
So if there are, say, 3 founders in working partners, and one founder puts $100,000, other 2 founders, all 3 of them are working together, but only one person puts money. It's not really friend or family, but it's individual money from one founder. How do you?
So the question was, what if there are 3 founders and one puts, in addition to their contribution, some actual dollars? Then what happens? And a fact is, it could be handled multiple ways. But one way to handle that is that, if the founder who's putting money, that person is also contributing code and intellectual property, then it could be that you say, okay, I'm putting maybe $10,000 in or $0 in as a founding stock. So when you put your intellectual property in exchange you have to buy actually your founding shares, but you set the price very low when you start the company. You set the price of the company founding shares like a thousandth of a penny. So $1 million you pay like whatever, $10 or $100 for 1 million shares. So that person can still do that, and then that person can do a convertible note also, which will convert in, and that person will get preferred shares. So when I started my current company, so I had 2 other co-founders. They were been working on a product. They had code and prototype. They put their IP into the company. I put $100,000 cash into the company, and that's how we got our common shares. Then I put additional money as a convertible note, so that I can get preferred shares also. So that's maybe a fair way to deal with that. Yeah.
If one of the founders puts in money and gets preferred stock in return, wouldn't that kind of put a valuation on the company?
Yeah, that's why I'm not saying they're getting preferred stock, they're getting convertible note. So in the future, when there's a VC round, then that will convert into preferred. So you don't want to put a price on the company too soon, because you're a smart guy, but you're not expert in valuing the company. So don't. Yeah.
One way to do also, which I have done in my previous company.
Maybe you can stand up and say who you are so people know.
I'm a Shyam Das. I'm also a charter member for a long time.
And part of the TiE Angel Investment Committee.
And right. And what I have done in my previous company is all my intellectual property, instead of in lieu of intellectual property, I will get preferred share. What Naeem is saying that you can get common share, but you have to be smart enough to negotiate with your investor so that you can get preferred share.
Well, there's a couple of problems
Yeah.
with that, because you have to be accredited investor. Now, Shyam is accredited all his life, so he doesn't know the difference because he's been accredited. The definition of accredited is you have to have a net worth of $1 million or more, and an annual persistent income of $200,000 or more. So since he lives in that world, he thinks everybody's accredited. But that.
Is it necessary? I don't
Yeah.
think you don't put any valuation. Say that,
So you're doing a convertible note.
no, don't take the in lieu of all my intellectual property, I get so many shares of preferred A.
Well,
I'm the only
yeah.
owner
So
of-
his point is, for people who may not on the for video, that you can get preferred shares as founders. I find that to be highly uncommon, and the VCs are going to be frowning upon it. Now, of course, there are all kind of radical movements happening right now, and this is one of the radical movement. But let me teach you the baseline, then radical stuff will be corner cases. Let me not take you there. Let me teach you the baseline stuff first. But those are a special case, which is happening. I agree with you. But let's see what the baseline is. So the question was, yeah.
Can you talk about the common shares versus preferred shares?
Yes, we will talk more about them, but basically, if you're putting your sweat, heart, and tears into the company, when you start a company, you get common shares. And that's the most common type of shares. If you're putting real money, dollars, into the company like investors do, they want to protect themselves from the downside when things don't go well. So then they insist that they get issued shares, which provides that protection. It has many clauses attached to them, such as, some of these things will sound strange, like liquidation preferences, which means that if the company ever has an exit, who gets to take the money off the table first before anybody can touch it? Then there are anti-dilution rights, which normal people don't get. We'll talk about some of these. And then there is an information rights and veto rights and bunch of rights. So those call them preferred shares. And this is really to design when things not going to go well. So as most founders, they say, that's never going to happen, so yeah, fine. But they know better, because more often that's what happens. But then again, if you are successful, the week before you're going public or the night before, then all preferred shares convert to common. So all those things are designed to protect when things are not liquid. When you're successful, ready to go public, the investment banker converts. There's a special conditions when you can convert, and then they could be converted to common. Then when you go up, everything is clean now. Everything is common. So, question which often gets asked, which is right now on the table. Yes, sir. Yes, I'm trying to, but I'm not doing a good job. Yes, I will repeat the questions. And if I don't, raise your hand, and that'll be my secret signal that I did not repeat the question. You can raise the hand like this. So this means repeat. This is like asking a question. This is a repeat a question. We'll come up with a new symbol here. So question is, yes, sir.
So I was just looking at slides, you even put the CFO role there, so I was wondering.
Yeah, I did not put the CFO role, because most companies at this stage don't need a CFO. And most companies at this stage will have a rent-a CFO, and there are a lot of rent-a CFOs available, which spend maybe half a day to a day with your company, and then you just pay them like a consultant and a little bit of stock option. You need a CFO when you get to something going like Series B or C or whatever, but Series C and Series A. So this is, I'm showing you after Series A, what kind of amount are given to various titles. So, this is an average. There are all kind of nuances and special cases. You can read them on the internet. But I just wanted to make sure that you're not like totally shocked with some numbers. Yeah.
Who gets the major share?
So, question was, who gets the major shares? Founders. That's the whole point of starting a company. Now, if the founder is also the CEO, then you hang on to that bucket, and because someday you may need a CEO. Okay? Question in the back.
Board of advisors.
Yes, question is, what about board of advisors? And answer is, you give them, it's a special case, because everybody is driven by different things. Some people are driven by, fame. Some people are mercenaries. Some people are just happy that you're talking to them. So, if you look at the Gaussian curve, it goes from 0.1% to 2%. But the middle, 3 sigma in the middle is 0.25% to 0.5%. And so what I do is, normally you want everybody to be vesting over 4 years, and we'll talk more about vesting, what is vesting. But if they want to negotiate that this is too little, I said, well, what if we just reduce the vesting to only half the time? What about 2-year vesting? And I'm even go down to 1-year vesting because most advisors after 1 year are not useful. Whatever you're going to suck out of them, you're going to suck out of them in the first year. So you can negotiate that way and still preserve and not give them more shares. And they understand, because you can give them 1% of the company, but you can fire them after 1 year. You only have spent 0.25%.
But still it is approval of the board, right? You know, even if you
Any shares to be given will require board approval. Any shares to anybody.
In the beginning, boards only the founders, right?
So question was, is the board all founders? Yes, in the very, very beginning, but as soon as you have investors, then investors would want to be on the board and will be controlling the board. So you can do some of the shenanigans early on, but it's not a good idea. Because when investors come in, they want to see, they will do legal due diligence. If you have been doing shenanigans like this, giving 10,000 shares to your uncle, another 10,000 to your ex-girlfriend, then they will be very hesitant to put money in the company, because if you're doing shenanigans before, you probably will do them again. And so you want to run a crisp, clean shop. You don't want to do any shenanigans. As clean as it is, it's easier, it goes down easy, exit is easy, raising money is easy. So those shenanigans should be avoided at all costs. Yeah.
At what time does a founder look for a CEO?
At what point does founder look for a CEO? And answer is when a founder recognizes that he or she is running out of her capability to run the company. And it will be beneficial for the company and for her and him as a stockholder to bring in a person who can do that job. Look at the Google boys. You know, they were smart enough to know they're smart people, but they are no CEOs. Eric Schmidt came in, everybody's happy. It's not always a happy situation. So you have to do the sensible, long enough dating period. But the bad news is if you don't fix the problem, somebody will fix it for you. And then you will have less say in the matter. So a smart thing is get the company going, get to your first prototype, maybe even first 1 or 2 customer, and that's a good point to see that I had a vision, I delivered it, now am I right person to scale it further? And don't get freaked out, because if you get to select your own bride rather than an arranged marriage, chances are you'll be happier with that decision. You know, arranged marriage work, we all know it, we all used to it, we know the statistics. But you know, it's still fun to pick your own. Yes, ma'am.
When you start the company, there are 3 founders, then how do you make the agreements or papers such that at Series A it will end up like...
No, so this is for outside CEO. So her question was, if 3 people start the company, do we have to follow this? And the answer is, this is for if you have to bring an outside CEO, these are the kind of the approximate breakdowns. But if one of the founder is a CEO, then you don't spend this line, you just save that stock, because someday you may need to spend it to the future CEO. So if you're 3 founders in the beginning of the company, you may have to have a conversation, who's going to play what role? And this should be honest and open conversation. So when I was doing my last company, Bitzer Mobile, you know, we were like, you know, in the beginning we were like 6 years old playing soccer. Everybody was where the ball was, on top of the ball. Nobody knows their positions. So I had to have a conversation with my co-founder. I said, you know, how are we going to run this company? So we decided that any technical decision Ali will make, any business decision I will make. So let's play our post relatively. So yeah, I was the CEO, he was the CTO. But you know, we obviously kept each other informed on everything we were doing, but we separated so everybody's playing their own post. Just like in football, soccer, you know, gotta play your position.
So is there a document that says that each one is 33% partner, or somebody is 40% and 2 others are 30%, or how do you divide the...
So question is, how do you divide the equity at the formation? And answer is, you divide that by having a conversation over some mango milkshake. You know, just sit down and that's what the conversation you have. How are we going to divide it up? And you may decide it's equal, and you can write it up a simple 1-page document and sign it. Because when company is formed, then shares will be issued properly. So if you haven't formed the company, then a simple one-page agreement is suffice. And when you issue the shares, then the lawyer will advise you and everybody will get the right number of shares. But remember, I have a lot of material to cover on this stuff. Allow me to proceed. Some of these questions may be answered automatically. I got 53 slides. I'm on slide number 4. Yes.
Sorry to stop you, but let me ask you one more question. You said something about if 3 founders were to start a company and only one of them puts money into the company, then he gets to have common shares. Is that what I heard?
No, what I was saying that the question was asked by this lady from IBM, if I'm not mistaken, that this is a unique, somewhat not the normal scenario that you have 3 founders and one is a rich one.
Okay.
So question is, he's saying, well, why am I putting my 100,000 in? Where is your money?
Right.
So one solution to that problem, there are multiple solutions. One solution is that they said, okay, the money you're putting in is a loan to the company as a convertible note.
Sure.
And whether other investors put money in the VCs, it will convert into some shares, and they will be preferred shares. When you're putting real money in, then you can demand preferred shares. If you're putting your thought, sweat, IP into it, that's what you get common shares for. In general, baseline case, yes.
Okay.
All right, let's go to the next milestone here. So we talked about this, Now, if you wanted to learn more about compensation, like how much to pay people, here's the links for you so you can, do all your study you want to do. And you can just Google this thing. These things talk about compensating and what percent shares. A lot of material available. So this is some of the question you were asking. What if we start a company, 3 people, and one person falls in love with a Brazilian girl and runs off to Rio? That happens more often than you think. So he's got 1/3 of the company, you got 1/3 of the company, and he's nowhere to be seen. How do you deal with that? What if somebody has a death or disability? So these are the issues which could come in the way, and the answer to that is one word called vesting. So vesting is the concept that, look, this is your stock. Nobody's taking them away. It's like, imagine a cookie jar. The cookies are yours, but you only get to eat 1 cookie per day. You can't eat them all. So this is the same idea, that it's your stock, is your name on it, but you don't have it. You have it slowly over a period of time, typically 4 years. So this idea is you got to work to get them. 2% per month, so about 4 years you get all of the shares. Idea is somebody has to be there long enough to add value and earn that share. And this also applies to founders. Why not? This happens all the time. Founder can fizzle out. So since you want, for tax reason, you want to purchase your shares, so your long-term gains period starts early. So then usually in that, when you founder shares, there's a buyback agreement, which is like vesting in reverse. That if you leave after 2 years, company has a right to buy the remaining unvested shares at original price, which is like close to 0, which is the same concept. Yes, sir.
What if someone doesn't run away to Rio but doesn't perform?
So question is, what if somebody just doesn't disappear but doesn't perform? And answer is, then again, the CEO has to make a decision. And sometimes CEO has to fire the founder. And in that case, when the founder is terminated, same thing happens. How long the founder was there, those stocks are vested. What's not vested comes back to the company.
Instead of giving all the stock up front and having it vest over 4 years, are there scenarios where people give half the stock up front and give more after a trial period?
Yeah, but so question was, what if you don't give all the stock up front? Just give half the stock up front and then let them vest. Again, this goes back to you adding unnecessary complexity. Because with the vesting, you have the same amount of control. Because when vesting could be turned off, if you're terminated, so why play those shenanigans? More you make a deal complex, the VC used this term, the deal has hair on it. You want deal with no hair on it. Clean as you can be.
But if this happens before a CEO is hired, then the partners have some kind of a voting.
So question is, what happens if this CEOs happen? So there is no partnership. There is a CEO from day one. To form a company, C Corp, you have to anoint somebody the CEO. It has to be filled in the form. So whoever assumed the responsibility of CEO, or if that he or she is not doing it, then the board has a responsibility to act. If you don't act, you're setting up a bad precedence for company and other people, and other employees say, hey, if he's putting up with that, I can be bad too. So it's just many bad things happen. You have to be decisive.
Is it problematic or simple to start the company as an LLC to begin with?
The question is it simple and easy to start the company as a he said LLP, but I meant LLC. So this is one of my pet peeves. I get very emotional about this subject. And I think last time I was a bit emotional about this subject. Don't. There is absolutely no reason, no benefit. It's not cheaper. It's more complex actually. And no VC will put money into LLC. I don't know, people love the word LLC. They gotta have a LLC. Absolutely not. You're having a C Corp, that's your only option. Don't even think about it. You're wasting everybody's time. There's only one option. Do LLC, do a C Corp. That's it. There is a 300 years of law which knows how to protect shareholders, directors, everybody. That's the only thing people understand. You know how the shares work. There's no advantage of doing, and short answer to your question is, yes, you can convert later, but you'll spend the same money twice. And there's no advantage to it.
I'm really interested in everyone's questions, but I really want to see your presentation. And
I know. I think I need to do a better job.
like a Q&A forum.
Yeah, there's too much Q&A. So I think Q&A we can do after we finish the main gist of it, because many people are sacrificing something important right now to be here. So let's get the gist of it out. Then I'll stay as long as answer as many questions as you want. Now my chief producer has a question. What do I do with that? He can turn off the camera. He controls the camera.
I understand his concern.
Yeah.
He may be trying to save tax.
There's no tax saving.
No, what I mean is he can offset that against ordinary income. So maybe a possibility, a better solution is an S corp. S corp is easy to convert to.
Again, I'll have this discussion later, but I'll convince you, no. It's not a debate. I have this debate all the time, and at the end, it's the same answer. So I'm tired of having the debate. If you're running a grocery store, buying an apartment building, sure, do an LLC. You're starting a company which is going to go places, don't. But here's the problem with this vesting. If you're vesting 2% per month, you know, I hire a guy doesn't work out after 6 months, I get rid of him. He's got 6 months of vesting under his belt. Before I know it, I'm going to have several dozen small shareholders. That's very annoying because you have to get their consent, you have to chase them down. So that's why we invented the cliff. The cliff. Cliff says you get bupkas for 1 year. So if I fire you in 9 months, you leave in 6 months, you have vested nothing. But on the 1 year anniversary, suddenly you jump to 25%. And then it's 2% per month. So for a board of advisor, people like that, you don't have to use the cliff. But employees, you use the cliff. Even founders, you can use the cliff. But mainly it's for employees. So idea is so you can get rid of those people who may not work out, so you don't end up generating too many shareholders. Okay. Should we get into the next big topic? This was just a preamble, just to get you started. So now the topic is dilution. How does this dilution stuff work? What happens to my shares? Do I have to sell my shares to the investors? How does it work? Well, so let's take an example. This example will reveal and answer many questions. So the example is 3 people start a company, because that's our favorite scenario. So you can pick a number that how many shares should you authorize, and how many share of those authorized you should issue. It's totally arbitrary number. You can start the company with 100 shares. The only negative of that 100 shares is when you hire your VP of marketing and he's all excited, he goes home and tells his wife, okay, you got a new job, yeah. How many shares did you get?
1 share.
2 shares. It's 2% of the company, but just does not sound very exciting. So that's why you use like a number that sounds like a 200,000 shares. Yeah, that looks pretty good. So you start with, you can have a 10 million shares. You can start with a number like that. Could be 1 billion, for example, but then it begins to look ridiculous. So, you got to be somewhat reasonable. So it's not unreasonable to start with a number like 5 or 10 million. I'm just using 10 million in this example, so it's easy to do the math. So these guys were smart. They didn't take all of them. They said 25% will reserve for employee stock option pool. and other people we may need to attract. So their simple cap table looks like this. They reserve 25% for those employees and board of directors. They have 75% among 3 founders. Then they raised some money. They took some time. After about 6-7 months, they found a VC. The arm wrestled the VC down. After much negotiation, they agreed the company's valuation is $2 million. Now, as soon as somebody puts a value on the stock, on the company, immediately you can compute the price per share. Since you had 10 million shares outstanding, you just divided the number. Now you know the price is 20 cents a share. It was an ambiguity until then. Now you know it's 20 cents a share. So great. Now you want us to raise $3 million. You sell shares at 20 cents a share, which means you issue 15 million. I'm coming to you now. Let me finish the sentence and I'll come to you. So now because now you at 20 cents a share, you're raising $3 million. So you issue 15 million new shares out of thin air. You don't have to sell your own shares. So now what happens is that when you do that, now your post-money valuation is 5 million. Because you had 2 million pre-money, which you agreed after much negotiation, 3 million of fresh cash came in. So the total value of the company, we call post-money valuation, is 5 million. And since you issued 15 million new shares, you now have total number of shares are 25. So your cap table looks like this. So a gentleman over there has a question. Yeah.
Concerned about your comment about intellectual property.
Yeah.
Because you said you don't like, I mean, you don't really care about it. But how do you come to a pre-money valuation without some kind of partnership or something?
So question was, how did we arrive at a pre-money valuation if we ignore the value of IP? So my feeling is I have been to many meetings as an investor, as a VC, in the boardroom, as a founder. So I've seen the movie many, many times. The way people arrive at a value of the company is not, they show you all kind of, I mean, they don't show you, they tell you that we did complicated spreadsheet, we looked at you, we looked at the competition, we looked at the market dynamics, and this is the number which works for us. In fact, behind the scene, what really happens, they have to figure out, okay, we're going to dance with this company for like 3, 4, 5 years. What is worth our time? How much money we have to make to make it worth our time? So they have their internal computation. They said, we got to make at least $30 million, or what's the point? All right. So if we own 18% of the company, and company will likely to sell, we think, about 90 million, what will we make? Is it worth our time? Because all the venture funds are being evaluated on a metric called IRR. Internal rate of return. And in venture industry, expectation is that you will give a IRR of better than 20%. Historic average is 22.4. So they do this internal. So this internal computation, like in Sequoia Capital, if you take Sequoia's money, I'm told that Sequoia won't put money in unless they can make 100 million on the deal. So right there, if Sequoia owned 25%, your company has to somehow be sold for 400 million before they can make their 100 million, which means if you're looking for a quick exit, goodbye. They won't let you. Sure, company sold for 50 million, you can make 10 million, you can, that's great for you, but they won't let you. So that's why you have to be careful when you take somebody's money. What is their objective? What are they trying to get out of it? The question is, better to have IP. Duh. If you don't have intellectual property, who's giving you money? Why? What do you bring to the party? Just because you're good thoughts? So yeah, it's intellectual property which has the potential to become something is why people invest in you. But the point is, we don't arm wrestle my IP is worth $1 million or $10 million. That's not the conversation. We're not trying to license a patent. Yeah, if you're licensing a patent, then even then, the net would be that somebody will come up with a valuation of the company. We can spend, some time, half an hour discussing different way to value the company, but it's neither here nor there, because that's not a decision any of you will need to make. So, this is amusing to say how they make it, but since you don't have to make it, you never go to VC and says, Mike, this is my company valuation. That's not your number. You're not expert in that. It's their job to come up with a value. is it good to file a patent? Answer is yes. But don't waste time, because most things you think are patentable are not patentable. There are a lot of attorneys who will take your money and file something and be rejected later. So make sure it's worthy of patent, because VCs can also see through this thing. They haven't seen the movie before. When time comes for legal due diligence, they'll have independently check it out. Is it patent worthy? So most things are not patent worthy. So if it's really patent worthy, yes. Does patent add value? Yes, patent establishes, or even the fact you applied for a patent, that you got something as compared to you got nothing. Everybody knows to prosecute patent is long and expensive. To sue somebody for a patent, you start at $100,000, it goes into millions. But the fact that you have something which may be worth something, may be worth trading, is a good thing. Yes, so if it's good to have a patent than not have a patent. Yes, sir.
Yeah, so back to the pre-money valuation.
Yeah.
If you have multiple VCs coming in to invest in you, you can get a pretty good idea of what your valuation is going to be, because you can compare one valuation to the other. But more often than not, an entrepreneur is only going to have one investor coming in. Are there general rules of thumb to figure out whether or not that pre-money valuation they're giving you is fair?
So the question is, how do you know the pre-money valuation is fair, especially when you have a solo horse in the race? And answer is, you don't know. What are your alternatives? So every time I've raised money, it has been one VC. Well, one Series B, I was able to manage to get 3 term sheet, and I was able to play up and raise my valuation. One VC came at 10 million pre, one came at 17, one was at like 13 or 14, but I was able to negotiate. But that's very seldom the case. Most likely, you're happy, one guy's finally you're able to convince and is interested. Then you make the argument of reasonableness. What's reasonable? Your key phrase you use is, we're going to be partnered in this thing, and you want our head in the game, don't you? So let's do something which is fair. Sometimes you can even mention that, you don't want to have the reputation of squeezing the founder. Of course, you don't want to quite say it that way, but I've said it to VCs, and they said, don't worry about my reputation, worry about your own company. So, it's a question, what choices do you have? I mean, it's silly to say, in a market that this guy's selling apples for like 5 cents an apple, you're selling for $1. What's going on? So go buy from that guy who has nickel an apple. Well, he doesn't have any left. Well, then that's how the discussion goes. So then a cap table looks like this. And then what happens? Suppose then another year and a half goes by, and you work hard, you have now a couple of customers, things are looking good. So now you go to your new investor, Series B, and after much negotiation, you agree on a price of 10 million pre-money valuation. Because you have, company has made progress, you have more things going on, and now as soon as you arrive at this number, you have 25 million shares out there, you divide the two numbers, boom, you got your new share price, 40 cents a share. By the way, this young lady, there are many seats available in case you wanted to sit down, but I know you want to leave soon. All right. So now, as soon as you have the new share price, now people want to put $8 million in Series B. Now you have a share price of 40 cents. You divide the two numbers. That means you get 20 million new shares are issued to the new investors. Yeah, question.
In these future rounds, let's say there's someone who's contributed a lot. Can you give that person additional stock as well? Let's say one of the founders contributes a lot more than.
So question was, is one of the employee or a founder, can that person get additional shares? And answer is yes, but it's not necessarily tied to funding, because you have a stock option pool. So anytime you want to reward some employee or keep them, it's appropriate to give them additional shares. But this time, you're not giving them founder shares or Series A shares or Series B shares. You're giving them stock option from the stock option pool, which you set up. So if you see in many founders, you will see, if you look at it, S1's prospectus of any company which went public, it will show you they got additional shares as options. Yes, sir, in the back.
I get really confused with the pre-money, post
Yeah.
I think we should kind of explain that a little bit.
Yeah.
And then I want to understand about this option pool business
Yeah.
where the investor is saying it has to be in the pre-money versus post-money.
So the question was, what is this pre-money, post-money confusion is all about, and how do you create this investor pool, and when and how? Is it before you raise money or after you raise money? So answers are simple. Imagine a glass of water is full, this much full. Then you pour some new water into it. Now it's this much full. So this was the pre-money valuation, and now you put new money into it. Now that's your post-money valuation. So if company was agreed, the company was worth $10 million after much negotiation, this is your pre-money valuation, because you agreed with VCs that they will put money at this price. As soon as the new $8 million comes in, now your post-money valuation is 10 plus 8, 18 million post. So this should not be too confusing.
No, you really cleared it up.
Yeah.
I'm worried about this.
A stock option pool. Okay. So question is, now here's you bring a very important point. Should we create this additional shares for stock options so we can attract employees and executives before the new money comes in or after? Because the implication is, if you do it after you come in, then all the people will get diluted, including the new investors. New investors don't like that. They make it a condition that before we put money in, you have to add 2 million shares to the stock option pool, which is unfair because the founders and the initial investors get diluted because number of shares go up. But if that's the only offer you have, what are you going to do? You can beg, you can make some fairness argument, but the argument which works really is the following. Look, we have enough shares, we know what you need to hire for the next 12 months. So we have enough shares in the pool to get through next 12 months. And after 12 months, then we'll issue shares, everybody will take the dilution. So this middle point is kind of sort of almost always works, unless you have bad investors who say no. And I'm going to give that scenario in a few next slide again. Yeah.
If the preferred share, we're going to have anti-dilutive rights.
Yeah. Yeah, so the question, anti-dilutive rights, the question was, but why do investors care? They have preferred shares with anti-dilution. Anti-dilution applies to new funding. It doesn't apply to this kind of a stock option creation. That's it's a special case. But don't worry about, you guys are worrying about minutia stuff. This is not, this is that, we're all desi engineers. We get worried about like, how this crank doesn't work. Who cares? You got to put your energy on the more important stuff.
No, I'm not worried about minutia. I agree with you. Money in my company. But the thing is, I read these books and where they talk about this option pool, whether it's pre-money or post-money, they're not a big deal or
So short answer is, it'll almost always be negotiated by the new investors to be before they put their money in. They want you to dilute yourself. They say, you want my money? Do that. Now, how to avoid that? You have 2-horse race or 3-horse race. If you're smart enough to get multiple investors, then you say, look, this investor is not holding me to do this, so I'm not going to do it.
I'm not there yet.
Yeah. It's hard to be there. Okay, so this is what happens. And this is what I was going to throw in the example to illustrate the point. And I'm making it a simplified example here. Simpler example is that they do want to add 5 million shares to the employee stock option pool. And in my simplest example, this is done after the Series B is already raised. Because example was, there was enough shares in the pool left that I could hire enough people for the next 6 to 9 months. And then by that time, I needed to add more shares, then everybody takes the dilution. So this example, we issued 5 million shares to the pool, total shares are 50 million, and your pie looks like this. Founders are now down to 15%. Option pool just got bigger, so they're 15%. And Series A investors are here, Series B investors are there.
So in this example, both the Series A and the Series B guy also got diluted.
Not Series B guy, Series B. Oh, in this example, because the option pool, yes. Because I'm just making it, because this is not the class to have the nuances and minutia. I'm giving you the big picture quickly so you can 10 minutes understand how this damn thing works. That's all I'm trying to do. So So yes, I'm simplifying the example. In this case, people were so nice. Because there's a lot of other topics to cover. So this is what happens here. Now you do sometime later, another 2 years later, do Series C. Now you have customers worldwide, things are looking good. You arrive at a pre-money valuation with a new investor coming in, because every time you want a new investor coming in, by the way. Why? Because your existing investors say they want a new person to come in, a new investor to set the price. Because if the price goes up, like in this example, went to 50 billion, they get to report to their limited partners, look, we made an investment and his price has gone up. So they look good, the company, their valuation is going up. But if you don't have a new investor, then you are in a dilemma. You want the price of the new round to be as low as possible so you can get more of the company. On the other hand, it doesn't show the company has gone up in value, so you don't look so good. So, which one do you take? So almost always they want a third party, new party to come in and set the price. And sometimes they do that, and Sequoia did that in the case of Mobile Iron. They got a valuation of like say 100 million. They say, okay, now we'll put money at 120 million. So they still wanted to keep more of the company, not give it away to other people, but they had a justification that third party valued it at this much. They rejected the term sheet and put money at a slightly higher valuation. So shareholders did not complain. The gentleman in the back. Oh, that was a question. See, some of the questions are built into the remarks. Yes, again, you're almost reaching your maximum 5-question limit here, but go ahead.
I'm hoping by Series C, I have a CFO who will explain this.
Yes, you're absolutely right. But it's not very complicated, guys. Honestly, it's not complicated. You get freaked out. You said, no, it must be complicated. It's not complicated. There's nothing that complicated about it. So then basically, since you had 50 million shares, and now the price was 50 million, so I just made a simple number, so my math is easy to see, is $1 a share. So you're putting in $15 million of new money at $1 a share, so you issue another 15 million shares. So total post-money is 65 million, 15 million new shares, so total outstanding shares are 65 million. Amit, looks okay? Yeah. All right. I got one person in the room who I have planted here to agree with me. So now the table looks like this. And I'm just giving the example of what a good scenario happens, because now what happens is after some time, you're ready for an IPO. Now the VCs are out of the picture. Now you bring in an investment banker, like Morgan Stanley or Goldman Sachs or whoever else. They say, forget everything which happened before. Let us look at the company. We'll tell you what the company is worth, what the real public is willing to pay. They come up with a price of $100 million. Great. So now, $100 million, we have 65 million shares outstanding. So let's go public at $1.70. Yay. That doesn't happen. People have an optical expectation that any company going IPO must be priced between $6 and $20. And some mutual funds are prohibited from investing in penny stock, anything less than $3. So they have to make this optical correction. And many of you who have worked at a large company may have gone through this. There's something called reverse split. It's terrible. It feels terrible. It's not terrible, actually. You had like 10,000 shares, you were looking at Tesla, things were looking good, and suddenly you have 2,000 shares because there was a 5-to-1 reverse split. So this was purely done optically because you have 5 times less shares, but they're 5 times fatter. It's an optical correction. So your 100 million shares, 65 million shares become 13 million shares, but they're more valuable shares. And now you go public with 13 million shares. And now 100 million valuation, divide 100 by 13 million is $7.70. So you go public at $7.70. And you sell 2 million shares, and now you raise $15 million. Once you have gone public, it's very hard to go out of business. Because now you don't have to convince a bunch of difficult VCs to your story so they can give you money. Now you can just float shares and you can convince grandmothers at home that this is a good idea. So you can always float additional some shares and people will buy it and you can raise more money. That's called a secondary offering. So once company have gone public, then secondary offering is when they actually just make shares and sell them and raise money for working capital. So this is sort of the whole story, how it evolves. But the punchline of the story is the next slide, that what happened to founders? So look, founders had 7.5 million shares, 75% of the 10 million. They continue to have 7.5 till IPO, they got 5-to-1 reverse split. But the share price, all the ownership went down from 75% to 10%, but the share price and the wealth went up. So this is the whole point, is that think about, don't worry about, I only have 10%. My good friend, my college roommate, Asher Aziz, started this company, FireEye, all by himself, solo founders. So he went all the way to Series E. So he had 100% of the company in the very beginning. So he only had 11% of the company at IPO. Company had an IPO about a year ago. And stock opened at 40, and he was worth $500 million that day.
Excuse me, you're talking about FireEye?
FireEye. And then it went to 97. I had since I was his college roommate, I got some friends and family shares. Of course, I did not sell at 97. But so point is that then, so suddenly, my point I'm making is that although he had only 10-11% of the company at the founding, but wealth was a big number. And that's what really matters. So stop freaking about percentages, stop freaking about number of, 12% or 10% or this or that. It doesn't matter. This is the real picture you should be focusing on. Speed of execution matters. It's not my valuation is 11 million versus 10.5 million. Yes, you can negotiate that, but don't keep your eye off the big picture. Big picture is speed of execution. Yeah, question in the back?
This might be slightly orthogonal, so please feel free to defer it, but what is the yardstick of when you go IPO? Because clearly being profitable.
What's the yardstick when you go public? And answer is, it's a some question you'd never have to answer because your investment bankers will tell you. But it's basically the potential for a company to make returns from the shareholders. So company like Twitter or somebody, but they had revenue positive, but their company could be negative. A biotech company goes public on a negative or zero revenue because the potential of what they've done, the drug discovery, is such that people are willing to buy the shares. So it's the potential. Whether it's revenue, in biotech, it doesn't have to be revenue. It could be your patents.
No, my question was slightly different. Is once your banker come and tell you that now you can go public, what as a founder or as a CEO, what conditions do you take into consideration before deciding, oh, I may be able to go public now, but should I go public?
So question was, if you're able to go public, should you go public or what should you be worried about? Again, that question applies to only 2 people in this room. But the answer is, going public, the good thing is you have liquidity. You cannot buy the shares in the company, and you cannot buy a Tesla with that. You need money, cash. So your grocery, your house in Tahoe. So liquidity, not just for you, but all you people who worked hard to get you there. You want liquidity. The negative is now you have scrutiny. You have intense scrutiny. Actually, I have gone public. Quick turn, we started in 1987, went public in 93. Life was not fun after going public, it was much more miserable. We all had Porsches, but we were miserable. Because now you have to, every quarter, you have to report earning, you set expectation, you can't meet them, stock is hammered, you cannot do any shenanigans at all. You can do some shenanigans before, like pay yourself a bonus. Now everything is under scrutiny, so it's not as much fun as it looks. But on the other hand, it's liquidity for employees, and your ability to raise money easily by secondary offering gives you, it's the cheapest money you can raise is through public markets. It's the cheapest money you can raise, so that's the reason you do it. So question is there anything here we haven't discussed? No? We talked about all these things. Yeah. A new question asker. Okay, welcome to the club.
At what point do you decide to go IPO? investment bank might actually tell you out of their own internal motivation to go public, where it seems to be a bear market.
So question is, at what point you should go public? So answer is, your board will decide, and it's mostly, many times driven by, because remember the VC funds are at 10-year partnerships. In 10 years, they have to find companies, invest in them, make them grow, and then go home after 10 years. So if that 10-year window is coming, they'll hurry you up into acquisition or going public, because they have to cash out the chips and return the money to limited partners. Irrespective of that, it's market conditions. Sometimes like good technology has been trying to go public for the last 1 year, but the market conditions are not letting them for what they do, so because of history of the company and whatnot. So point is market condition. Are you able to not only just sell shares, but have company in a place when you can sustain it? Because the worst thing happen is once you set the expectation, you're not able to meet, you'll be slammed by the market. So you have to have ability. But honestly, those questions, although intriguing, are not relevant to 98% of the people in the room. So I should continue to move forward, except the most anxious question askers.
What is it best practice for the first item for reserving for advisors and consultants? 20-25%? What should be?
Yeah, typically is no less than 15%, but probably no more than 25%. I've seen as much as 30% reserved for that bucket. Remember, if company is acquired before the bucket is spent, those unused shares are not counted in the denominator. They're just set aside but not used.
Quick question.
Yeah.
So how binding is a one-page agreement? Yeah.
It's,
I mean, you have a legal agreement.
yeah, this is among just the founders, some things written down. It's how binding is it? It's not terribly binding. But it shows an intent. And because by the time you go to form the company and you want to honor that intent, what you wrote down, you should have a serious question about, do you really want to marry that girl? So yeah.
One thing, in American law, even if you didn't sign the agreement, if I agree and there is somebody who says that, yeah, witnesses that is illegal, as good as legal agreement.
That's absolutely right. Because even verbal agreements are binding because you set an expectation. So when I say it's not terribly binding, you mean that if somebody wants to break and say, I don't want to work here, what are you going to do? Yeah.
I understood this dilution model. So aren't there examples where founders have raised a lot of money but continue to maintain majority voting rights, just like Google?
So question, I think if I understand you correctly, was do founders keep the majority voting rights? And answer is almost with some very, very end case exceptions. When you take money from VCs, they may not have majority ownership, but they will have 100% on the control. Control doesn't come from how many shares you own. You can own 40% of the shares of the company and have 100% of the control. Controls come from those protective provisions, from the board level control. There are other places to get control. They can have veto rights. It's written something like, you need a 60% majority of Series A to issue additional shares. And you say, yeah, that looks pretty reasonable. Sure. But what it means is, if they say no, you're screwed. You cannot issue more shares. You cannot release a Series B. They have full voting right. But it's written so politely that you're almost like, yeah, sure, that's very reasonable.
I would like to share something. In my second company, when I raised the money, at that time, the VCs wanted majority share. Then that's where the negotiation comes in. I negotiated, do you want control or do you want
ownership?
Financial gain.
Yeah.
He said financial gain. I said, okay, I'll give you whatever share you want, but condition will be we both have voting together. No decision can be done unilaterally. And therefore, that's what I do.
And Shyam's answer is, if you are Elon Musk or Shyam Das, you can negotiate that. If your name's Zafar, not so much. So yes, everything is negotiable based on who you are and what leverage do you have. So let's talk about cap tables, because you have heard the word cap table, and it's So some people in the back of the room, they want to reach for the CFO right away. Like, it's above my pay grade, don't know what is cap table. Is a baseball cap, what kind of cap are we talking about? So cap is short for what? Capitalization. So this is what they look like. I'm going to walk you through a cap table. What does it look like? It's not as complicated as it seems. Actually, you can even make it yourself. So you have different investors, and this is how many shares they got, and this how much percent they own in the beginning of the company. So total shares were 5.3 million. So this is at the very founding. That's what the cap table looked like. Then after some time, we raised some angel money, and we said that there'll be 20% discount. And so this was the initial stuff that we saw. Then when we did the angel round, one investor, just like your example, decided to put $100,000. One of the founders also wanted to put $100,000. This person got a convertible note. And some other angel investors came in at this amount. So total amount was $750,000. And since the price of the round was going to be 93 cents, actually I need to show you the next slide first. Anyway, their share price was 75 cents, so you divide this number by 75 cents, that's how many shares these people issued, and this is what the cap table looked like. Yeah.
So if the angel investor got 20% discount, why did Amy not?
Amy got it too. Amy paid 75 cents. The normal investor paid 93 cents. Let me show you the next slide, which shows how we arrived at that number, because this number was arrived at once we agreed on a price pre-money valuation of 10 million. Did I do that? So I need to my calculator to figure out, did I compute, or somebody can compute it for me. I think we agreed on a price of 5 million. For these investors, this lead VC who set the price, he paid 98 cents a share, 93 cents a share. But Amy, since she got a convertible note, she paid 20% discount, she paid 75 cents a share. That's why for $100,000, she got 133,000 shares.
Same as angel investor one.
Same as angel investor one. But lead VCs, they set the price, they got whatever the price was set, which was this many shares divided by $5 million. This was the price arrived at, and that everybody got the shares. So total shares now are 6.3 million. Then sometime later, we do a Series A at 10 million valuation. Actually, this is the actual cap table from my last company. I just changed the names of the people.
Who's Sanjay?
Yeah, Sanjay got screwed actually. Sanjay kept getting zero because Sanjay pulled out. So now we arrived at a share price, and because we had this many shares outstanding, divided by 10 million, the price was $1.36. And then when VC put in this much money at $1.36, they got for putting $3 million at $1.36, they got 2.2 million shares. And the VC owned 23% of the company. And we just added 1 million shares to the employee pool so that we have enough pools there. Yeah.
Does this assume that there was a convertible note in the founding process from the angels?
No, not the founding process. A little after the founding was done, we did a convertible note for some people to put in money. So Amy's money came in several months before the lead VC's money came in. That's why Amy got the convertible note price.
When did angel investor 1 and 2 first put the money?
They put the money early.
Okay, so there was an early money that they...
Yeah, I should probably indicate that with some color code that whose money came in early, who was late. So only person who paid the full price of 98 cents was the lead VC. Yeah.
So if, say in January, we start the company and angel gives $100,000. In June, one of the founding member adds $100,000. In August,
Yeah.
there is Series A funding.
Yeah.
Then does this June person, just couple...
So good question. This is suppose some angel investor put money in January, and right before the VC money was imminent, let's say in August, one of the founders decided to put in $100,000 and ask for the 20% discount.
Less discount.
So this falls under the category of hanky-panky. That you're trying to take inside information, and that will put a dark shadow. it's not worth getting this extra 33,000 shares in the big picture of scheme of things. So that shows these people are already going to play games. So investor will be very cautious, maybe even walk away. Because chances are, if I give you my $10 million, what games will you play then? So this is now, let's look at, if this was the cap table, what happens at the exits. So after Series A, Amy owned 22%, Holly had 20%, David had 8%, so on and so forth. So if company was to be sold at, let's say, 125 million, 35 million, or this million, this tells you how much money each person will make by simply multiplying this number with those appropriate percentages here.
What was the company sold for?
What is the company?
What was the company sold for? You said it's a previous company.
Unfortunately, it was sold to Oracle, and if you know Oracle practice, you know, they tie you up in very strong non-disclosure agreements in which they can take your money back if you ever say it.
I hope you made at least 3.3 million.
Well, that's what my wife would hope. Life is always more complicated than it looks because there are things like liquidation preferences, which I'm not talking about, and whatnot. So point was, and again, if you can do it, if there was a pre-VC fund, which means before you took the VC money, so all the conditions don't apply, early exit at 10 million, how much would the people make? You notice, I just put this column here so you can see that before you take the money, Amy makes about the same amount if company was sold for 10 versus company sold for 15 after you take the VC money. So which means once you take the VC money, all kinds of special conditions then start applying, and what you make will be substantially less than if you had not taken the money. So look at this. Company sold for 50% more valuation, but Amy and Holly make the same amount. Yeah, which means that VC will take most of it. So that's how the VC whole system works, preferred shares work. But this is just wanted to give you a taste. What does a cap table look like? It's not scary, it's kind of common sense. Even you can do it.
This is what CFO gets paid for.
Yes, that's what people CFO get paid for, you're right. So what are some of the common mistakes? So one common mistake is, of course, not taking care of vesting correctly. Issuing too many shares, people disappear, and then things are no good. So I talked about vesting earlier, you know what that is. Not having a founder's agreement. No, don't take the picture. I'm going to show you eight mistakes. Then take the picture. Otherwise, you'll be taking 8 pictures. The poor guy is taking, very obedient, taking a picture on every slide. I have 8 bullets. I'll give you a secret signal. So not having a founder agreement. So you think you have this arrangement and this person will be full-time and you don't have it and they don't honor it. And so it's good to, once you have a legal entity, of course, all things are translated into a number of shares. But even before, have at least a 1-page agreement so it's clear what the expectations are.
So when all the founders have full-time jobs, how do you deal with it? Is it okay to have agreement?
What's wrong with it? If you all agree to this thing, then you should be, over a slice of pizza, you should be able to sign it. Because people, I have seen it too many times, people change their minds. If not, their spouses change their mind for them. So just to be safe.
Here is the problem, right? That, say, if we sign it too early and the person is not wholeheartedly in, then companies mature, future.
So question is, what if you sign an early founder agreement and then you sign a new agreement? Whatever. When things change, you just say, okay, new condition, this supersedes any previous agreement. This is a new agreement. Not a big deal. Having too many board members, too many shareholders, because you want to have a clean thing. You don't want to make all the founders on the board. All the founders, one person should represent all founders. And that's what they're going to make you do. So you don't want to put your uncle and other people on the board. Yeah.
On the example you gave prior, what would your recommendation be on board members?
So all the founders, one person will be on the board representing all common shareholders. So typically what situation is after the Series A, you have 5 people on the board. So one represents common shareholders, one is the CEO. If the CEO is one of the founders, then that's like 2 votes. And VCs will have 2 votes. And the 5th person will be, again, it's a negotiation, will be either chosen by the VC, but acceptable to founders, or chosen with mutual agreement, or something like that. So those language can make an effect. But usually, trust me, if VC is putting money in and you're the first-time entrepreneur, they'll have control of the board. Now, if you're Elon Musk or Steve Jobs, a different story. But that's not happening anytime soon. Yeah.
What about Series B, C? How does that progress?
So then when you have Series B, then same kind of things can happen. What will happen is that Series A people had 2 board seats. They'll relinquish 1 board seat, and Series B will take that board seat. When you go to Series B, then they may have 3 seats, 1 for A, B, and C. And then you bring in another independent board member. Because as you grow to that size, you need more independent board members. Because to get ready to go public, you need to clean up all that stuff. Sarbanes-Oxley, I hate that.
That's what happens is when you take more and more money, different cities, you keep getting more board members,
Yeah.
and you lose control.
Yeah. So then, raising money by one of the worst things you can do, and I've done that. I've made almost all of these mistakes, by the way, so it's not like I've not made them. So advice to you, do not hire a Korean divorce lawyer as your corporate attorney. He was cheap. So what he did was he made us sell. We were raising some money. It was 63 cents a share. He said, no, it'll be simpler. Let's not do preferred share. Everybody common. Everybody's equal. I said, okay, common sounds good. No, because now my stock option price had to be 63 cents. Because when you put a price on the common share, then you cannot issue stock option below that number. So that's this fingerprint sensor company I'm talking about. I had 500,000 shares as a CEO. I couldn't exercise 500,000 shares at 63 cents a share. You have 90 days to exercise. I didn't have $300,000. I left 500,000 shares on the table. Company was that I was orchestrating a reverse merger of 3 companies with a public shell. Shares floated at $6 a share. I left that money on the table. Couldn't, because this mistake I made. Don't ever sell shares to common shares to investors. Sell them preferred, because then because there could be a delta of price between preferred. If your preferred price is 63 cents a share, your stock option price could be argued to be 6 cents, 10 cents, 8 cents. It used to be like 10-to-1 ratio, but thanks to my most hated law of Sarbanes-Oxley, now you have to do an evaluation by a third party. 409A is called. You can do a Google search on 409A. So point is, it still could be 5x, 5 times lower. So that's how you can justify lower stock option price, so you can keep important employees. So don't make that mistake. Now, some of you think, you can high-five yourself. We got a great valuation. We're somehow able to snooker the VCs. We got an $8 million valuation Series A. Yay, high-five. Well, let's be careful. Because if the Series B people value your company, their pre-money is less than your post on the last fund, a tsunami of bad things will unleash itself. And who gets hurt? The founders, the common shareholders. I'm coming to you in a few minutes. So for example, if the last valuation you were able to convince them to do 8 million pre-money valuation, you raised 5 million, so your post was 8 plus 5, 13 million. After a year of working, your Series B valuation is less than 13. It leashes all kinds of anti-dilution clauses and all kinds of other bad things. Investor will come out okay, you will be screwed. So be careful. You want to raise a high valuation, but not so high that it will come back to bite you. Question over there.
Sir, on your earlier point on hiring very competent attorneys,
Yeah.
what's been your experience in terms of the commercials per hour, especially for a growing startup?
Commercial per hour?
No, for the right attorneys. Is it like you hire them on a consulting basis, or how much it be?
So question was, how do you select a good attorney?
And what has been your experience on the?
And what has been my experience getting an attorney? So I think as long as you stick with one of the firms which have multiple names in them, you're okay. Don't go with a name with a single person's name in it. That's my advice. So if you go with a more famous one like Kleiner, Perkins, Caulfield and Bayer, that's the VC firm. Yeah, Wilson, Sansini, Goodrich, and Rosati. about Oric, about Pillsbury. I mean, they're all okay. They're all good. They're all very expensive, unfortunately. So my favorite, by the way, is I find an attorney in one of these big firms with multiple names and wait for him or her to go solo. So that's what I pick up. I follow them. I said, now they go solo, the rate drops from $700 an hour to $350 an hour. So I lock them in. That's what I do every time. And that works pretty well. So I use those ones who have used to be with big firm, now gone solo. Everybody wakes up money. But I think the way to select an attorney is find out which attorney hangs out to entrepreneurship events. Because you may not realize it, most of their attorney lives are pretty boring. So they seek excitement just like we do. They come to this, the one who are intrigued, come to a TiE event, and they like to talk to entrepreneurs. So that's the one you select because they have some sympathy towards it. The one who are too busy to leave their office, they're billing at $1,000 an hour, let them just stick with Google and Apple problems. They're not right for you. So now you can take a picture. The biggest mistake you can make, which you absolutely should never make, is not filing a Form 83B. One way you can tell, and I'll tell you what 83B is, because if you make a mistake, almost every problem could be solved by an attorney with enough money, except this. This cannot be solved. If you have shares, founder shares, which are subject to vesting, you have 30 days after you purchase these shares to file with securities with IRS Form 83B. And if your attorney is not forcing you or freaking out about it while they do your incorporation, fire that attorney. So that's a good way to tell if they're really on top of the startup scene or not. Because if you don't file within 30 days, this Form 83B, and you want to file it with return receipt requested, you have a proof they got it, because they don't got it. What will happen is, as your shares vest on a monthly basis, as far as IRS is concerned, you're getting ordinary income every month. Suppose you have 1 million shares. So I got to divide by 48, whatever, but you're vesting 20,000 shares every month. So in the beginning, they were like close to zero, but now they're worth like 50 cents. So as far as IRS is concerned, 20,000 shares just vested at 50 cents this month. You due tax on $10,000 of ordinary income is due now. You'll be really screwed. And this is one problem they cannot solve. I had to shut down the company and restart the company. Fortunately, it was very early, so no damage had been done to solve this problem.
So this is only if it's subject to vesting?
Yeah, it's subject to vesting. Now, stock option pool, if you're giving stock option, that's a qualified IRS plan. That you don't have to do this. This is for if the founder's shares are subject to vesting. Or any shares you purchase, the shares that are subject to vesting. Founders or non-founders, whatever. So any shares subject to vesting, by filing 83B, you're free and clear. The only will pay tax when you actually sell those shares. Yeah.
If you are the only founder, do you still need to file it?
So good question. If you're only founder, so you still need to find 83B. Well, question is, if you're the only founder, are you going to make yourself subject to vesting? And answer is, it depends. Because if you're going to take other investors' money, like VC money, yes. Because if you don't, they will. And they may want to start the vesting period when they put the money in, which is 2 years later. You might as well just do it now, because they're going to make you. Why? Because they don't want to put $10 million or $2 million into the company, and next day you take off for Bahamas. They want you to be working in the company, so the vesting is to force you to come to work every day. So they'll do it. So you might as well do it if they say, oh, you have vesting already? Oh, yes, sir, of course we have vesting. We've been vesting. 4 years? Yeah, 4 years. All right. Let's move on to the next topic. So they'll ignore it. But if they don't, then they'll force you to do it. So you might as well do it. Now, this company I'm doing right now, Telesense, I did not do that for myself. Why? Because I don't plan to take VC money. I plan to put my own money, take angel money, get company to profitability, and hopefully not have to take. If I have to take, then I'll go fix it, start the vesting again.
How do you fix it?
But then you start the vest, then whatever shares are unvested that day, or all the shares will be subject to vesting retroact. So suppose I have 4 million shares now. So when suppose I have to take VC money 2 years later, they'll say, okay, 2 million of your shares are subject to vesting, or 3 million. Or maybe they'll start with all 4 million. then I'll argue, okay, fine, but vesting started when I started the company, which was 2 years ago. Some half vested already. There'll be some negotiation and say, okay, fine.
But can you still file 83?
At that time, you'll file 83B at that time. And you may have to, I'm not a lawyer, you may have to do maybe issue more shares and buy them. Some lawyer will, again, it's above my pay grade. But that's the idea. Yeah.
Just to make sure I'm clear on the vesting portion of it. So say, for example, you start your own company, you're the sole founder, and you start your vesting from day one over 4 years. So after 2 years now, you've got half of your vesting done.
Yeah.
You take VC money. Will they reset you back to zero, or will there be some negotiation?
So question was, if you were a good boy and you started investing, even if you were the only founder, and 2 years later you took VC money, would they make you restart the clock? And answer is, it's a point of negotiation. They may ask that because they say, and you say no. And you may compromise. They say you'll start the vesting, you cut the baby in half. They'll say, we'll start it 1 year after you started. Or if you're a strong negotiator, depending on what else are you negotiating, you say, I'll accept your crappy valuation, but I'm not going to accept this. Then maybe you'll settle that. So it's a point of negotiation. But reasonable VCs will not make you restart.
What does Elon Musk or Shandas do?
I didn't understand. What is
Elon Musk. If Elon Musk or Shandas were in that position.
Yeah, in that position, if a famous founder says, then they may say, no, we are not restarting it. This is it, take it or leave it, because I can find money from somebody else.
Look at Facebook, look Google.
Yeah.
How did they do that?
Yeah, Google, Facebook, special cases. Yeah, special cases. So when you have, what is the difference between negotiation and begging? The only difference is leverage. If you have leverage, it's called negotiation. If you have no leverage, it's called begging. So those people have leverage. And all of you should create leverage. Yeah.
So if you are still working and still your startup is going on, you got product kind of ready. So 83B, filing 83B while you are still working for your regular employer, not the startup, gets you in trouble.
So question was, if you're still working for a current employer, issuing the shares, the 83B, can you do it? Fact is, true conversation. Filing 83B has only thing to do is when you're purchasing shares subject to vesting. Whether you work for an employer or you don't work for an employer, it doesn't matter. But the second thing you should be worried about is, what is the conditions of your current employment agreement? If you are working for a company like Intel, for example, don't. Because they have the most restrictive agreement. Even if you're dreaming at night, it belongs to Intel. So each company has a different law. And IBM probably has pretty strict also, but maybe not as strict as Intel. Intel is like the worst.
I was with Intel for 13 years and I got stymied twice.
So that proves my point. You're doing gardening and you thought of something to do gardening better, it belongs to Intel. So it depends on your agreement, how strict it is.
Usually a clause in that agreement also, unless it is conflicting with the business or a speculated business. That's where.
So you're right. The clause is. So you're correct. It depends. So what I said was read your agreement. Depends on the clause. It depends on the company. In case of Intel, it doesn't matter. Even if it doesn't conflict, someday it will conflict, and so they apply it.
Well, they say speculated.
Yeah. So depending on how legit.
You're not going to fight Intel's.
Yeah, you're not going to fight the lawyer. So just don't go there. But point is that the point you're making is an important teaching moment here is the following. It is very critical how you leave your last employer. This friend of mine, Ashar Aziz, which I gave the example, so he used to work for Sun at that time before he started his first company. He actually videotaped him going to all the servers, he was working from home, going to the root and doing delete star. And he videotaped himself doing that he erased everything. That was his proof that I'm taking nothing. So that's the kind of level you need to raise. Don't take any documents, don't take any instrument, don't take any knowledge which could be accused of. You don't want to pollute your IP. If you pollute your IP by being lax, you have trouble raising money, you have trouble getting acquired, you have trouble later, just don't do it. California law protects what's in your head. What's in your head, you can use that knowledge to make money. Not what's in your head. If you memorize the customer list, that may be protected. So. But in general, point is what's in your head, you learned part of your profile you can use to make money. And now in New York and Texas, not so much, not so friendly towards employee. California is friendly towards doing that. So you have to be careful about this. This is one reason you want to befriend an attorney before you quit your job, to make sure you do it right. Last topic, term sheets. What does a term sheet look like? What is this big term sheet we've never seen before? What's in it and how do we negotiate it? So I'm going to simplify that for you. So you know that how VC fund you. VC give you money, you give them shares. And they get, of course, preferred shares because they protect them when things don't go right. So we looked at that last time, and we talked about this example. Yeah. So this is a repeat from the last slide, so not to in the risk of boring some of you. But it looks like not all of you remember, so it's okay maybe. So this was, am I going to give you another example? Really? So this is the example, I was going to show pre-money and post-money, what you asked earlier. So this example was, suppose you arrived at a valuation of 3 million, VC put in 2 million, what percent does the VC own? Somebody said 40, what else, other answers did I hear? 56, 60. Actually 40 is right, because remember pre-money valuation was 3 million, when you put 2 million more, now post is 5. So 2 out of 5 is 40%. So point is that this is just to define what is pre-money, what is post-money. Then let's talk about term sheet. What the heck is a term sheet? Term sheet is a non-binding offer to invest. It's a non-binding offer to invest under certain terms and conditions. And I was telling you last time, some of you hate to repeat the joke. The happiest you will be in this process is when you see the email arrive with the term sheet attached and before you open the term sheet. So rejoice that moment. I've learned now, having done enough time, I take a walk around the block, call my wife. I don't open the term sheet right away because I know it's going to be bad news. So is it? I'm going to go there. I'm going there slowly. I know the point. Yes, yes. Look at the last point here. So it's a non-binding. It's 4 to 8 pages, which says that we're going to invest in this valuation, and this is the terms and condition, and you would give you like 72 hours to sign it, and they really hound it. Now this is the problem, because once you sign it, instead of putting the ring on your finger, then you cannot be shopping. And although it's non-binding, there's one clause which is always binding, which is the no shop clause. Because once you sign it, you cannot, and it is confidential, you cannot discuss the terms with any other investors. They'll tell you that. And then there'll be confidentiality agreement. And if you start shopping, then all kind of damages can occur. That will be the binding clause, and they definitely enforce that one. So don't take that lightly. Once you sign it, you have put the ring on it, you're off the market. Now your trouble would be, and typically if you try lucky enough to get more than one term sheet, you want to sort of like bounce off each other and get the best deal. So, I had to play all kinds of tricks, like my attorney is in Portugal, I'm sorry, I can't get him, I need more time. Then we trying to get the board together, but the board is not available, one guy is in Lisbon or something else, and I need more time, so I usually get about a week, but you don't get more than that. You have limited time to agree, yes or no. So how do you negotiate? And what topics do you negotiate? So I'm going to give you 3 buckets, how you can analyze these things. So first bucket is economics. So in economics is, of course, the pre-money valuation. What is the money worth, which means what is the stock price will be. Is the employee option pool will be opened before or after? That's sort of a dilution issue. So you want it to be after you have raised the money. Then how much are we raising? 1 million, 2 million, 10 million? That matters. Then the famous thing called liquidation preferences. So liquidation preferences is an interesting concept that says that if I'm putting in, let's say, 5 million, if company is sold, I get to take that 5 million or a multiple of it off the table before anybody touches anything. So this is their way to protect on the downside, because if company is sold for 10 million, they want to take their first whatever. So typically it's 1x, but sometimes if you are novice founders or an aggressive VC, they may ask for 2x or even 3x. Now, after dot-com bust, we saw as high as 10x, but that's like a rape, so that's absolutely not acceptable. But people did that. There was time like that. But 3x, I have been forced with 3x. I have fought back. And then again, I'm not going to give you full education because there's a lot more to study, and my book, Get Funded, gets into it. But we only have about 20 minutes to get through the rest of it. They come in two shapes. Preferred shares comes in two flavors, participating and non-participating preferred. They sound so benign. You say, yeah, participating, sure, we all want to participate. Yeah, participating. But the fact is, it's bad news. You want non-participating. The reason is, participating means that after they take the liquidation preference off the table, then they come back to participate again. It's double dipping. But you'll be surprised how many VCs offer and how many, actually last Blitzer Mobile, I was offered that. And since I teach this course, I said, absolutely freaking not. So, but most people, they say, yeah, sure, participate, yeah, great. And then, of course, there is anti-dilution, and I'll talk a little bit more about it. And as you can tell by the name, full ratchet. Sounds bad already, doesn't it? Full ratchet. So this is, we'll take a little bit closer look at a couple of them. But basically, this is, like I said, liquidation preferences, in the case outcome is not so spectacular. So they want to get their money off the table first, and then, so if it's a non-participating, so you either take your liquidation preference or you convert and participate like normal people. So this is useful. Suppose an investor owned 40% of the company, and they put in $5 million. So if the company is sold for 10 million, their 40% will give them 4 million. So you don't want to convert. You want to take your liquidation preference. That will give you 5 million. But if the company was sold for 20 million, then what is 40% of 20 million? 8 million. In that case, you don't want to take your liquidation preference. You will convert and take 8 million. So it gives you a chance to either do this or that if it was non-participating. If it was participating, you do both, which just really screws the founder. So, we can spend half an hour on this topic, but I just want to give you some vocabulary so you can be smarter about asking these questions. Next thing is anti-dilution. So obviously, what happens if the next round is the less than this one is post, the example we were discussing a few minutes ago. So early investors want to protect themselves. So you have a couple of things you can negotiate. So I'm giving you some example. Suppose Series A post was 12 million. Boards, now things are not looking good. You're going to raise money at 6 million pre, so it's a down round, which means the pre-money of this round is less than post-money of the last round. So this is a down round scenario. So what will happen? Because this is how much people you had raised. Now the new people, you're raising $3 million at 50 cents, so you're going to issue 6 million shares. The Series B investor will own 33%, and Series A people will go down to 27%. So this is the situation. I'm going to show you in the next two slides what happens if you had anti-dilution rights. So one slide, we will look at if the anti-dilution was full ratchet. If it's full ratchet, what happens is basically that Series A people get to issue additional shares as if when they put money, the price was today's new low price, as if. So because new price was 50 cents a share, because it was full ratchet, they had 5 million shares, they get additional 5 million shares. Now I have 10 million shares. This is to protect them, so their percent goes to 43%. So who gets screwed? The founders.
But even Series B.
So Series B doesn't like it. So Series B investor may say, well, we're not going to give you full ratchet. Either you change your mind or we are going off or whatever. So that's right. There's a tension between the investors, A and B in this point. But just to understand the math, and if you were weighted average, which has this complicated formula which you can memorize at night, based on the value, you give some additional shares. In this example, they got 1 million additional shares. So instead of 27%, now they went to 31%. Lot more easy to swallow. So you're not gonna no need to do the math. All you need to know when you sit down, you ask your lawyer, what kind of anti-dilution are they asking for? I'm just giving you a vocabulary so you can ask slightly smarter question and let the lawyer explain what the difference is. Just like when you go to a French restaurant and you don't understand this poulet marsala, what do you say? You ask the waiter, do you have any chicken on the menu? Yeah. Let him point, oh, this is chicken? Paulette, who knew? So this is my trick. When I go to a foreign country, you pretend like you're so casual. Yeah, is there any chicken on the menu? So this is the same thing. You ask smarter question to your lawyer. The gentleman who has exceeded his limit is given a bonus round.
When you have a down round, isn't it better to wind up the company rather than just...
So question was, if you're having a down round, is it better to wind down the company? You'll be surprised how many famous companies you know had down round. FireEye had a down round. Tesla had a down round. All the companies who look so pretty and famous, you have no idea how much crap they have gone through, which is all shoved under the rug now. So answer is no. All the famous companies you know today, the success stories, probably have plenty of this kind of stuff happen to them. Nobody talks about it when things are looking good. So you don't shut down the company. Like a smart entrepreneur, you soldier on. Because your eyes are sitting at the end goal. You don't let this thing distract you. Big deal. So you went as a founder, you from 38%, you went to 36. Whoop-de-doo. So what? Keep marching on. Absolutely not. Okay, enough about anti-dilution. That's all you need to know. Don't confuse yourself. Yeah.
Do angels sign a term sheet or they sign another document?
So in the beginning, about an hour and a half ago, they signed the convertible note document, and when there's a Series A money comes in, then they sign, they're just a shareholder like everybody else, they sign the same document as VCs. Yeah.
Do companies, or as you think about a company in Series A, B, C, do they have typical attributes for revenue, customer?
This is a very good question. This is a smarter question than it sounds. No, it's a compliment. It's a backhanded compliment. The question is that this Series A, B, C, do they have a specific attribute? And how do I know? Because I made this mistake. I did Series A, and then I suddenly, we got a bank had a note, they wanted to put money in, I call it Series B. Then we took another small strategic investor, like $500,000, I call it Series C. And I did not realize that all these numbers have a very specific expectation in people's mind. When you go for Series A, you're developing a product. Series B means the product is developed, you're not trying to get some initial customers. By Series C, you have lots of customers for expansion. And I did not realize that. And by the time I was reading Series D, I was just starting to finish the product development. People said, what's wrong with Series D? You don't even have a product? What's wrong? So next time I got smarter, I started calling them Series A, A1, A2. Because by the time you say B, it means something to people. So it's a very good question.
So it's tied to product? It's tied to phase of product?
It's tied to a stage of the company. Expectation. And this is, again, not a legal definition, it's an expectation. Somebody says, I'm a VP, use some expectation, this guy's probably making over $150,000 to $200,000. You don't expect him to be making $10,000. He's like, something is wrong. So it's an expectation is set up, yeah. So second bucket, first bucket was the economics. Is it a burning question?
Well, just a return on investment question. Isn't the risk higher much earlier, and a Series A investor should get a better return on investment than?
And they do. That's why the question was, isn't the risk higher earlier, and shouldn't Series A people get better? They do. That's why at the value they put the money is much lower. They put the money at 3, 4, 5 million valuation. Series B put at 10, 15 valuation. C is putting at 40, 50 million valuation. So yes, it's already built into that system, yeah. by the way, I'm not expressly saying it, but one of the rights you negotiate as part of preferred, that you have a right to put additional money in Series B and C, Series A investors. So they get to keep their percent. So they have this participation rights. Can they refuse? Well, that's again a point of negotiation. And sometimes if you refuse to participate, then there's something can happen. You can lose a board seat or something. So this is all negotiation, but this is part of the term sheet. Remember, we're only talking about big buckets. This is one of the detailed bucket. It doesn't matter to you so much as a founder, so like I'm not dwelling on it. But there are other nuances. Second bucket is control bucket. First was the economics, second is control. So what's going on here? Who has the board control, protective provision, shareholder rights, preemptive rights? This is where they can block you from selling the company and block you from raising money if they don't like the Series B investors, for example. So this is again a point of negotiation. What kind of control should you allow? But the third one, and your lawyer will advise you because you don't have too much leverage there. This is the one you should worry more about. Founder's treatment. How will you be treated? Because what if you're terminated? What if they put money in and next 6 months later they fire you? What happens to your shares? They can do that. They have the control. Well, Steve Jobs' company was already public, but yeah, kind of like that, yeah. So question is, you need to negotiate this now. This is the most important thing you should spend most of your energy on. For example, what happens if they terminate you with cause? What about termination without cause? Because they don't like the share. And my favorite, constructive termination, which says, and something like termination with good cause, or no good cause, whatever. The constructive termination is that you're not terminated, we're just moving you to Alaska, or Korea, or you could be janitor, you're changing your title, your salary, or your location of work. So you're not terminated, you continue to vest your option, but you make it so hard that you might as well quit. So you want to protect yourself against that situation. Yes, sir?
Yeah, when you were talking about vesting before, and if you don't like somebody, terminate them, shouldn't you have it written down somewhere what the conditions of termination?
Why do you think I'm giving you this slide? That's the whole point of the slide, is to talk about this topic. Yes. So that's what I'm saying. Absolutely right. You want to negotiate that up front. You want it written down. What happens if you don't like the color of my hair and want to fire me? That's why we're discussing this very slide, is right on topic. So question is, even cause. What's the definition of cause? What is a good definition of cause? Typically, I've seen in my contract, its definition of cause is a felony. But then I also negotiate felony except traffic related. Yeah. Could happen, by mistake, hit and run, who knows? So I don't want to lose the share. So you want to negotiate something like that. For example, the threshold could be negligence. Cause is negligence. That's a pretty low threshold. What is the definition of negligence? So you want to negotiate not negligence, but gross negligence. But gross negligence is much harder to prove. But of course, you may want to go a step higher. And you may want to negotiate willful gross negligence. Let me finish my joke here. Now, willful gross negligence is much harder to prove. But of course, if you're me, you take it a step further. You take it to persistent willful gross negligence. That is definitely very hard. And I have been able to negotiate this. So it's all in negotiation, that what is the cause? Persistent gross negligence, you have to be really, really screwed up to get that one. So, yes, sir?
I'm wondering, after you put all these things down that you negotiated, are there laws out there that can transcend what you wrote down?
So question is, are there laws which can transcend those down? Probably, but that's above yours and my pay grade, because when the lawyers will fight with each other and deal with it.
They define the term.
These,
At the end of the agreement,
they define the terms. Like I said, felony.
Gross agreement.
So, for example, my definition of negligence is felony, except traffic related. So, some people will negotiate that, but yes, there are some laws, but you don't want it to be sometime, you don't want to define it too broad, too specifically either. You want to, with this thing, I want to have it as vague as possible, because this is so powerful that you cannot prove it.
One thing about it, some of the laws will say you took advantage of a naive investor, of a naive founder.
Well, by the time you're dealing with VC, you're not dealing with not naive investors. So that's why. Yeah, then, so question was, do we negotiate as founders? The answer is no. These things kick in because this founder treatments, all this kick in when you have term sheet from a venture capitalist. And angels, they don't know how to spell that. So don't worry about them. All the way in the back.
We have similar steps for sexual harassment.
No. Wouldn't you like to know?
That's felony.
Yeah, that's felony. Well, depending on proven, but question is, was it persistent? एक दफा तो जोक शुक तो हो जाता ना. So that's why I had the persistent.
So this is good, serious, and good comic relief. But
Yeah.
can we shift the focus on cost to performance metrics?
It's very hard to, so question was, can we shift the definition of cost to something else like performance? You can, but that's even harder to prove, and even lawyers will have trouble with this because it's very hard in California to defend performance. Now, of course, you do all the normal things that, again, we're dealing with founders. Employees' threshold is lower. Short answer is yes.
Well, usually they define it as conviction.
Yeah.
If you are convicted.
If you're convicted. Yeah.
Therefore, if you are convicted, they will get you out of the company. They can do that.
See, I feel like I have a board member here. I cannot go too off the map here. My board member keeps me honest. I feel like I'm a CEO seat again. I have no freedom to move. So that's how you feel. I'm dealing with this. Exactly how you feel when you start your company. You can do jack because some board member is watching you all the freaking time. Yeah.
Yeah, but just thinking of it.
Let me hear from the young lady.
Can you also comment on constructive termination?
Yeah. So,
A little more.
yeah, I will, because these clauses, especially constructive termination, really applies after M&A, after acquisition. Because what you want to protect is if company is acquired, and I'll talk about this in the next slide actually, because this is when I'm going to talk about single trigger or double trigger. So this is what's going to cover that. So anyway, we talked about vesting. Typically for founders, you don't want to have a cliff. Oh, no, I didn't say 4-year cliff. There's never a 4-year cliff, but you can avoid the cliff vesting, and you can say start the vesting date early. Now, interesting is this change of control. Change of control is basically getting acquired when somebody else takes over the company. Yeah.
You didn't know acceleration there. What if the company, gets acquired in 3 years when the vesting for the founder has started? Don't you want to accelerate your at that time?
So question was, what if the company gets acquired after 3 years? You're almost fully vested anyway. What good the acceleration gives you?
Less 2 years, let's say.
Let's say 2 years. Well, it gives you a lot, because if you had 1 million shares, after 2 years, you only vested 500,000 shares. If you can vest some additional 500,000, that's a big deal. That's could be a lot of money on the table. So the point is, so let's talk about big picture first before we zoom into the questions. The acquiring company does not want to give you any more acceleration, because the whole reason they're acquiring you, because they want your ass in the seat working. Maybe, yeah, except for the CEO, that's usually the case. CEO, they want to be get out of typically, but yes. On the other hand, you said, I worked so hard, my whole purpose was to get the company acquired. I want to now some cash out. I want to go home. So this is where it comes in, that how should we treat this thing? So as founders, it's not unreasonable for you to say that if you get acquired and if you get acquired, we get some acceleration. But typically, the solution is a double trigger. Double trigger means we get acquired and your job changes, or you get terminated. Then you will get some benefit. So typically as a CEO, chances are you're not going to be a CEO of the new company. You're going to get let go very quickly. So this is, and your whole job was to build the company and sell the company for shareholders' benefit. So you want to now be rewarded for doing so. So that will be typical that if company gets acquired and you're no longer the CEO, then you will get the rest of your shares accelerated, or half of the unvested shares, or 6 months acceleration. So this is the kind of typically for VPs and other people, not the CEO. A typical would be that if you're being terminated after acquisition within 1 year, then you get a 6 months or 12 months acceleration on your shares, and you get 1 year severance, or 6 months severance, or 3 months severance. So these are the things you can negotiate if you get acquired and you're terminated without cause or constructively. So as a CEO, you're much more likely. So I negotiated, for example, 1 year severance and acceleration of rest of my shares. But none of the other technical founders got that because they were meant to be there. So, but they got some acceleration if they were terminated, and some severance if in case they get let go within 2 years. So this is what happens. I mean, this again, topic is rich and we can talk more about, there are all kind of nuances, but I'm just trying to give you a broad brush so you have enough knowledge to ask smart questions to your lawyer when that time comes.
The best way, my experience is, all these conditions, the founder agreement, you should do it before you go to the VC. Then it becomes very easy. Usually they will negotiate, but you have some...
You're absolutely right. So what you're saying is, don't wait till VC meets you to do this. So when I do the agreement, I automatically put in double trigger. Many you're tempted to do single trigger, that you just get acquired, you get accelerated. They're not gonna put up with that. So you start with double trigger, and you start with a reasonable, like trying to get yourself 5 year severance, unreasonable. Even 2 year severance, unreasonable, unless you're a CEO of a publicly traded company. So 1 year severance, a little bit on the high side, but acceptable. 6 months, very normal. And acceleration, 1 year shares acceleration, normal. All of yours accelerated, not so normal. So don't be greedy. That's your point. Don't be greedy, make it normal. VC will just let you keep it. But you get greedy, they'll change it. So some other blah, 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 which I won't go over. We talked about no shop agreement is important. And of course, there are other rights like information rights. So how often you have to notify, some of these could be negotiated. So how do you negotiate the term sheet? You basically work with a lawyer. This is not something you want to do yourself. So you get the lawyer, you sort of agree that there are 26 clauses. You're going to pick the 4 or 5 you're going to negotiate. If you want to negotiate 21 out of 26, as many Desi engineers love to, you're going to turn off the VCs most likely. It's going to be so hard. I'm going to work with this guy for the next 4 years. It's going to be so detailed all the time. So, you do what's market. Your keyword is what is market, what is normal. What's normal, okay, we'll put up with that. You pick the 3 or 4 items when I negotiate, and usually I negotiate maybe liquidation preferences, and I negotiate founder's treatment. Those are my top 2. Then valuation. Some people put valuation higher. I think it's not that important in the big scheme. It's in the ballpark, it's good enough. So, point is, since we're approaching 9 o'clock, should you take other people's money? Should you, all this condition I just told you, some of you may be afraid to take VC's money. Answer is, you take VC's money because it's a race. For example, if you can drive from here to LA in first gear, you'll be revving at very high RPM, it's going to be hard on your engine. Or you can drive in 5th gear, and you're revving at about low RPM, and engine is not even feeling the pressure. You'll get there faster too. So if you're doing a company when there's a race, taking the VC money and letting go of the control and some of these things gets you there faster, you win the race. And nobody remembers how it happened before. Nobody remembers you had, at the end, 12% of the company or 14.5% of the company. But if you be miser and negotiate everything, you slow things down, you're going to miss the boat altogether. But if you're doing some kind of a company when it's not a big race, like I'm doing this IoT company, IoT is going to be huge. We have seen nothing yet. There's no hurry. There'll be companies starting for next 20 years. I'm finding my little niche. I think I can make it profitable very quickly. So I'm not trying to race. I'm not taking VC money. That's my current thinking. It may change, but that's what I'm thinking right now. So this is my point is.
Thing I usually tell that always get a picture of the pie. It doesn't matter how small the section of the pie. If it is a zero pie, 100% of the pie is still zero. But if it is a bigger pie, the key is how to make the pie bigger. Right?
Yeah, exactly. It's not your percent. Think about the pie size, not your slice size. Because even a one slice in a 15-inch pizza, it's a dinner. But you have this mini pan pizza, all the pizza, still quite feeling hungry after that. Yeah. It's funny I'm saying that because I missed they ran out of vegetarian, so I'm hungry. So my analogy of imagining pizzas. Yes, sir.
I have a question. I don't know whether these topics are related. That is funding, raising money, related somehow to the federal government, Fed raising the interest rate or something, because maybe the easy money that which they talk about in the market.
Yeah. So question was that Fed playing with the interest rate, does it impact somehow your ability to raise money? The answer is, it's a complicated answer, but the simple answer is no. Now, it matters what the Fed is if the market is crashing. If market is crashing, then everybody wants to hang on to the money they want to put into these unknown ventures. So this is more of a psychology. When .com bust happened, many VCs pulled out. Actually, my Series D crashed on my fingerprint company because Infineon Venture pulled out a bunch of deals that week. So that's not the interest rate federal, that's probably more applicable to private equity and that kind of money. Venture money is a different bucket. So your takeaway from this session, because my job was to finish at 9 and we are 1 minute to 9, is, don't sweat this thing. This is the point my board member just made for me, is that don't sweat the dilution issue, make the pie bigger. See, I'm using your words. And the thing is don't get stuck, exit often. It doesn't, do it again. So you get kicked out, you're no longer the CEO, you're not the founder, so you got acquired, great. I'm free, I can do it again.
If you have shares and if you are kicked out, think that if they are making the company, those are the people working for you. Think in that.
Yeah, exactly, because you're still the owner. You're a shareholder, you're the owner. Other people are working to make you money. So the point is that hopefully what I'm hope to do, alert you to some big picture items like 83Bs and preferred shares and liquidation preferences. I don't expect you to memorize all these things, but I want you to be more aware and study more, Google these terms and become smarter. But I really appreciate you coming and spending so much time with full attention. That was remarkable. So thank you very much.